morning, good afternoon. That was a great intro. My name is Ethan Mayers, and I have done everything in the innovation sector. I have been a successful founder. I have been a multiple unsuccessful founder. I've been a team member, advisor, mentor, and for the past 2 years, I've been working in venture capital. Early stage innovation is one of the most critical parts of building a dynamic, resilient economy. But the way we fund it is fundamentally changing, and if you feel that, because it is. The next few years will redefine how we fund early stage innovation more than the last few decades. Today, I'm going to give you 3 critical insights into what I've seen of where we were, where we are, and where we might be going. Now, the theme of this conference is it starts in Moldova and goes global, but I invite you for the next few minutes to reverse that because I'm bringing the world of funding here to Moldova. And everything starts with a story. And in this case, the story begins about bad food. It's the early 1600s in Europe, and the food is terrible. This is very true. And people don't have, indoor bathrooms or electronics or Wi-Fi, so they spend all their money to try to buy better food. There's a group of islands called the Spice Islands. We know them as Indonesia. And guess what they have? Spices, appropriately named, right? It's very expensive to send a ship there. But if you do, and it manages to come back, because we have no canals, you've got to go the long way around, you will become really rich. And so someone had an idea. It was a profound idea that changed the world as we know it. What if we gathered capital together so we could split the cost of the ship, and we all take a share of the rewards? And this innovation created the entire modern financial system. Everything you know, if you're raising funds, came from this single idea. We had never, in humanity, ever done this before. We had never allowed the public to take risks together and share it. At its peak, adjusted for inflation, the Dutch East India Company was worth $8 trillion. It is still the most valuable company the world has ever created. For perspective, that's 2 Apples or Apple plus NVIDIA. It averaged 18% for 30 years straight and became the blueprint for everything you know in capital. Public markets came about in the 1700s, stocks, private equity came out in the 1800s, and we invented private equity in the 1900s, which comes to our first key insight, and this is critical. Capital is nothing more than technology. You cannot find evidence of term sheets, LPs, warrants, or any other evidence of capital in chemistry, physics, or biology. It was made up by a human to solve human problems. And because it's a technology, it means we can innovate it. We can change it. We don't have to accept it as it is. Now, what kind of technology is it? It's what we call a coordinating technology. What does it coordinate? Well, capital allows us to take a piece of the future that doesn't exist yet. Anybody who's a founder knows that. You're selling a vision of something that doesn't exist. It allows you to sell that vision today and capture and share that value over time. Now, for the next few minutes, I'm going to talk about venture capital, which is a specialized branch of this particular technology. Now, before I tell you where we are in venture capital is a very specific tool. Now, I review 2,000 pitch decks per year. And every one of you believes that you're venture backable, and I'm here to tell you that some of you aren't. So let me tell you what the rules of venture are. Number 1, you have to be going after a massive addressable market. Every founder in the world thinks they're going after a massive addressable market, but a massive addressable market is a massive addressable market, not a nice to have, it's a massive addressable market. That's fine, everybody thinks they have. Number 2, winner takes most dynamics. You're going after an industry or a place where you could get meaningful market share in a short period of time, and the winners, 1, 2, or 3, think about taxi companies or delivery companies. You got 2 or 3 major companies that took most of the value. But number 3 is the hardest. And I tell people this, and they don't like it. The basis of venture capital was that the incremental addition of a user did not change the fixed cost of a company. What the heck does that mean? Instagram doesn't pay very much money to add an extra user. It costs them a couple cents. There's no computing power. It's not a linear progression. It means they used to have a saying that we don't talk about anymore: build it once, sell it forever. So this is what VC is and VC does. In 2025, 50 million companies were started globally. 24,000 receive VC at any level, angels, any level of funding. You have 0.05% of ever capturing. But it gets worse. 70% of all that dollars that went to venture capital funds in 2025 went to mega deals worth at least $100 million. 50% went to a single industry, artificial intelligence. Trust me, you can't escape a talk like this without talking about AI. 18% went to one firm. Andreessen Horowitz now has assets under management of 1 out of every 5 venture dollars in the United States of America. But this is a term that you probably don't know, and it's called dry powder. Dry powder refers to undeployed capital. So this is money that a funder has available, essentially sitting in a bank account, that is available to circulate in the economy through an investment means that is not deployed. We have the most dry powder right now than at any point in human history. $4.6 trillion, almost $800 billion of it in venture capital, the rest of it's in private equity. Money is sitting there not being deployed. The problem is not a shortage of capital, and don't let anyone tell you that. The problem is an imagination of where to send it. Early stage is under threat. This is a whole nother talk, and I'm going to go through this quick because it's too much detail. But just know this. Coming out of COVID in 2021, 2022 was the worst cohort of venture capital in its history. Even the best firms barely average a 10% rate of return, and most of them were negative. We no longer have cheap capital. Interest rates are expensive. Private equity funds, having run out of companies to invest, went into early stage and drove up the valuations. And artificial intelligence has basically scrambled what we think of as value. We've tried to export Silicon Valley, but you can't. There are unique moments and places in history that can work, and unique moments and places in history that can't work everywhere else. And some places need to define with their own version of success. And you know what the most important thing is, everyone out here? You got smarter. It's been 40 years we've been funding early stage companies. You got smarter. You figured it out. Some of you rejected venture capital. Some of you wanted to build on your own terms, and that's a good thing. Now, AI will have an effect, but not the one you think. We are not killing employment. What we're killing are employees. Over the next few years, we will have more startups and more entrepreneurship and more small business than the world has ever seen, and venture simply can't fund them. Many founders are now starting business out of necessity, not out of ambition. That's a very different model, which requires a different fund. Which leads me to my second critical point. The dominance of venture capital in early stage funding is coming to an end. And that's okay. I love venture capital. I think it's actually one of the most elegant economic models we've ever created to align risk and value. But it's simply not appropriate for most of the companies that you're likely building, that we're building in America and building around the world. We don't need to innovate venture capital. It's fine. We do need to innovate capital for venture because the new founders are not building unicorns. We are entering the post-unicorn economy where people are focused on durable, profitable businesses with a revenue focus over exit dependency, and they're building locally and going regional. So what does that look like? These are nice terms. What does that actually look like? Well, the first thing to know is we didn't kill the ship when we invented the plane. Every year, everybody tells me, venture capital is dying, venture capital. No, it's not. It's going to be here for years to come. But its dominance is ending. So we have revenue-based financing, staged milestone capital. We have really interesting funds from around the world. Some of I've even met in your neck of the woods that don't quite fit the venture model, but runs what we call venture adjacent. So there's new funds coming out that are trying to fund very different models. The term sheet's being reinvented too. This is the document that defines early stage funding. Recently, I was talking to an investor that found a deal with what's called a commercial warrant. The strategic partner invested in the company and got the right to invest more based on how much money they bought from the startup. This is crazy. This is unique. But there's all sorts of things. So capital is moving and innovating. But here's the key that I want you to know here in Moldova. This is a global movement in redefining what success is and what early stage funding means. Brazil spent the last 2 decades redefining their startup momentum. They call it, and I'm terrible in Portuguese, oncocorneos, which roughly translates as jaguar. They said, we don't chase unicorns. Those are mythical creatures designed for somewhere else in an environment that doesn't fit us. We chase jaguars. They're purpose-built for our jungles. They retrain the investors. They retrain the founders. And they're one of the successful startup ecosystems. And although they've minted a couple of unicorns, most of their successes are not. They're $50 million, $100 million, $200 million exits. We've talked about building zebras instead of unicorns. These are businesses that do social good and profit. Camels, which are built for durable resilience. There's a concept called seed strapping, which is a concept where you decide to get one round of funding and don't pursue it anymore. The goal of venture capital is no longer. We've had funds, we've had instruments. This is being changed, which brings me to point 3. The menu is expanding, and the advantage will go to you who know what to order. Many of you don't need to go for VC, or you need to define something new in the models that are coming. Now, I want you to leave you with 3 things to think about. Number 1, owning a piece of company is one of the rarest permissions in the entire world. You don't need to let anybody into your company. And the few people that you do, 8.5 billion people, you might let 20, 30, 50 people onto your cap table. You need to have co-navigators on your cap table and people that believe in you and share your definition of success. Number 2, capital is a tool, and winning is getting better at tool selection. But number 3 is the most important, and it's the one I want you to think about. Success is not a destination you inherit. It's the route you choose. We have never had so many paths for success than we do right now. You don't need to let anybody define or tell you what success looks like. Success is not a VC check. Success is not a unicorn. Success is none of these things. Success is what you define it as. And the future belongs to those who will act with clarity, conviction, and confidence to define the success that means something to them, and find the people that are willing to share along with that ride. And that will define your startups and your ecosystem for years to come. That's why the future of VC doesn't look like VC at all. Thank you so much.